course, there you have it. But let's get into our first conversation on the show today. The influx of capital importation into Nigeria plays a pivotal role in driving economic growth and fostering business expansion and enhancing overall market dynamics. With the recent adjustment in the MPR by the Central Bank of Nigeria, investors and analysts are keen to evaluate how this policy shift will impart capital inflows into the country across various sectors of the economy. Data from the National Bureau of Statistics show that Nigeria generated $3.91 billion as capital importation in 2023, but also 11 of the country's 36 states were destinations for import. However, the total capital importation for 2023 is about 26.7% lower than what was generated in 2022, which was $5.3 billion US. Well, to provide some perspective now, I'm joined by two guests, and of course we have joining me from London, Mr. Gospel Bele is the CEO of Streetnomics Limited in United Kingdom, and Ms. Damilola Onemano, gender and research analyst at Budget, joins me in Lagos as well. Thank you for joining me, both of you. We appreciate you for time. But let me start with you, Mr. Obele, in United Kingdom. So data from the National Bureau of Statistics shows that Nigeria generated $3.91 billion as capital importation in 2023. And some analysts have attributed the larger part of the importation to President Tinubu's ability to stimulate investment shopping abroad. How does this reflect Nigeria's attractiveness as an investment destination? I think we should start from there. Hello, Mr. Obele, can we start from you?
Yeah, can you hear me clearly?
Yes, so let's start from you.
Fantastic. Yeah, there are two different things here. First of all, to note that an individual's capacity to rake in investment is a skill in itself. And that may not necessarily mean that the business he or she is trying to rake in investment for is healthy to start with. So we first need to give thumbs up to the president, which was initially, when he came to office, all of his travels and meetings and all that, they're beginning to bear fruits now. And we've seen that initial drive to spur investors' confidence, leveraging on relationships in the international market has, sort of improved the state of things a bit when it comes to capital being imported. However, it doesn't in any way mean that Nigeria is still a preferred investment destination, because the metrics in which we use to capture for investor or investment attraction or investor attraction, as the case may be for nations, are completely different. We want to talk about the ease of doing business, inflation, monetary economics, how easy it is to get contracts signed, how easy it is to, what are the bureaucratic and bottlenecks when it comes to getting business done to a very large extent. We're not yet there as a people when it comes to the ease of doing business in Nigeria and how attractive it is to do business in Nigeria. However, the state of the MPR and the exchange has also favored for investors in terms of looking at it from a capital and money market perspective. People can easily earn interest on the monies they invest in by virtue of the fact that MPR is high. But technically, when it comes to the business environment for MSMEs, manufacturing firms, and stakeholders locally who are actually pulling up the weight, is a negative impact on them in terms of the MPR. So overall, like I mentioned earlier on, there are two different dynamics. The president is very good in raking in investment. That doesn't necessarily mean that the home base is actually, attractive for investors.
Okay, so let me come to you, Ms. Damilola. Let's talk about, because there are top 4 sectors captured in the NPS, if you look at that report, including manufacturing, banking, financing, trading and shares are also part of it. So what factors did you observe contributed to their attraction in 2023?
Thank you for that question. Basically, for capital importation, we noticed, especially from the last report, that loans make up the most chunk of what has been an inflow into the country in terms of capital importation. There is a vast difference between what comes in as loans, which is about almost $500 plus $1,000 billion, compared to the FDIs and the FPIs. So in terms of like banking, the banking sector experienced a very fast level of profit last year, despite the slow growth in the economy all through last year, which is something that, yes, significantly we should look at, because if the sector is experiencing boom, whereas other sectors are depreciating, yes, it's something that we should look at. The manufacturing sector, however, will I say, also experienced a decline, despite the fact that, yes, it's one of the major contributors, but it's experienced a decline in the year 2023 fourth quarter, because as at second quarter, it was doing a $605 billion, and as at December, it was doing a $450 billion. This can also be attributed to the fact that the need of doing businesses has also dropped because of the fact that we are having higher exchange rates at the moment. We are also having difficulties in sustaining businesses as a result of the higher rates of getting diesels and petrols to fuel businesses. But in terms of financing, yes, a lot of shares, and because interest rates has also gone higher, a lot of shares are being sold at higher rates, in attracting investors in such a way that it boosts the economy.
Okay, let me come to you, Mr. Abele. Perhaps we need to look at a trend in the number of states getting investment, which has become very, very, discouraging. If you look at the report critically, Lagos, Abuja, Ekiti, and Rivers State altogether, pulled about $1.09 billion in the last 3 months of the year. So how can the rest of the state be positioned to become attractive destinations for capital importation, considering that only 11 out of the 36 states were recipient of foreign investment in that report, if you look at it very well? So that is the question. What happened to the other states?
Yeah, I'm not surprised to see that, by the way. But the first thing for us to, take note of or embrace in this conversation is that no investor would, want to invest in states that are not commercially viable. A critical number, over 80% of Nigerian states are not commercially viable. That's the honest truth, regardless of what they produce. All right. If you want to flip the conversation again, if you look at the VAT construct, the taxation construct at the FIRS level in Abuja, only 3 states also contribute relatively largely to that. You're looking at Lagos, Rivers, and slightly Abuja as well. And these 3 states are relatively consistent with the states that are attracting, foreign capital, as the case may be. So first and foremost, most states are not commercially viable, and that's to tell you that there is going to be a fundamental problem with, the future of capital importation and, and investments in Nigeria. But safe also to say that even the other 11 states that you realize that probably had some share of capital, you find that the majority of them probably even arrived there by leveraging relationships, leveraging access. So that's also to say that sustainably, or in the sustainable sense of things, Nigeria is not well positioned to access capital by looking at it from a subnational framework. All right. So there is need for us to locally, begin to infuse the right policies, structural reforms particularly, that can help to unlock for state competitiveness. The conversation of state competitiveness have been in the room for a very long time. All right. So we need to unlock state competitiveness. In fact, if you can't even unlock state competitiveness, you want to think about regional competitiveness, meaning how can we leverage regional efforts to position states to be investment ready? So there is also that conversation. Now, until reforms and strategic engagements when it comes to policies now are being tailored to unlock those possibilities, we cannot see any move, or we may not be able to find any form of traction, when it comes to investment. And it also triples down when you look at it from an ease of doing business standpoint. Locally, businesses in many regions in Nigeria are literally struggling by virtue of the market dynamics, all right? Because the market is not developing, consumer purchasing power is not growing in those regions, industries are not growing in those regions, in as much as they are resource rich, all right? So no investor will give you money because your states are resource rich or your country is blessed with one natural resource or the other. They will invest because you've shown prowess of industrialization and you're investment ready in terms of being able to attract investments.
I want us to dwell on that. You mentioned something very important, talk about the regional attraction as well. Within that year, state like Abia, Anambra, Adamawa, you have Niger State, Ondo, and Rivers only generated just about $166.2 million. And when you analyze then by geopolitical zone, no state in the Northwest region generated capital flow at all. So in the Southwest, you have about $2.53 billion investment, but excluding Oshu and Oyo State, so with no capital importation at all. So the report did not really give reason why that happened. I'm explaining this based on the background you provided, but at that potential, this state can leverage on to create opportunities, especially the Northwest that didn't attract. You have Osun State and Oyo State that did not attract in the Southwest.
Yes, there are potentials. I mean, looking at it from an internal lens, there is this State of Entrepreneurship report by Faith Foundation, which we're privileged to, participate in yearly in terms of driving that research. And we've seen that lots of states, particularly Oyo State, is emerging in terms of the dynamics of doing business, the ease of doing business, consumer purchasing power, and even market entry, market penetration possibilities for small businesses. Take, for instance, it's a lot easier for a local business who makes probably smoked fish and all that to find a product in quote-unquote a ShopRite in Ring Road than a ShopRite in a Ikeja City Mall, all right? Because the dynamics of doing business are a lot more easier, relaxed in those local economies. Now, the catch will now be that even if you have all of that, how are we taking those elements and how are we promoting them? Take, for instance, the Lagos-Ibadan transportation and rail network and all of that has also facilitated ease of doing business within the Southwest as an economic cluster. But those possibilities are not captured as pitchable narratives to foreign investors or even local investors at all. All right, we are not bringing out we are just talking about the rail network. We're not talking about, there is no data anywhere that tells us how many businesses have been created by virtue of that mobility that has been created right there. So these are the things that we need to project, both as data and as pitchable stories to local and foreign investors to begin to attract investment. We've not done well, even as a nation, generally as a nation, we've not done well in putting our image out there in terms of what we are doing subnationally and nationally or regionally to attract more investors or investment. What we've done to a large extent is seeking to lobby and sort of maximize individual relationships to rake in capital into the Nigerian economy. And that's what has happened recently. So we need to do more around telling our stories right and going more evidence-based in our campaign and pitch for both local and foreign investments.
I think I should come to you, Damilola. I mean, of course, I know you want to probably react to that, but let me get your recommendations in terms of what you propose for investment opportunities across the state in Nigeria. What would your recommendation be? I know there are quite a lot of opportunities across the state of Nigeria. For each state, what can they narrow down on? What do they have? Let me come to you, Damilola.
Okay, thank you for that. So basically, each state needs to focus on improving their ease of doing business. If you're talking about the Northwest not having any form of influence on capital importation, it will also boil down to the fact that there is a high level of insecurity in those areas of the country. No investor is going to want to come all the way to Kaduna knowing fully well that his journey back and forth to Kaduna is not certain, or is not certain of how his businesses are going to thrive if he's working in areas that are insecurity prone. So yes, improving ease of doing business. What is the power supply level? What is the ease of even getting the certification? Can I be in a UK or in a London like the co-guest here and say, I want to open a business and I can go on a portal and say, I have easy access to just open the business on that portal. What are the bottlenecks? What are the bureaucratic bottlenecks in place that prevents me from having that ease of just saying, I'm opening a business? Some of these things are things that chase away investors. But most importantly, the state needs to look inwards. Subnational states have the potential to do basically well in terms of investments, but they need to look inwards on what are their export potentials, what can they utilize and improve productivity on to be able to have these export potentials grow massively, not even not even in a minimal way, but to grow massively.
Okay, I think we need to get it into the conversation around the impact of MPR. Billy, perhaps you need to react to that. Let's talk about that. The impact of the new MPR at 22.75% is the highest in the history of the Apex Bank when it comes to, regulating or reviewing interest rate. So what potential influence could this have on asset management, especially in the context of capital importation?
Well, first and foremost, rising MPR always favor the financial market, or the investment market from an angle of those who are seeking returns. So when you look at it from the context of people who have their monies in the pool and expecting returns and all that, all of those interest rates are like the benchmark, for their different investors or investments, rather, to bring back returns for them. The challenge usually is on the user end of things in terms of not normal consumers and people who are seeking to even purchase assets and all of that. So to a large extent, we see it tilting more favorably and strengthening investors' returns in the sense of things. Because at the end of the day, when you have that, drive that across different sectors of the Nigerian economy and even different assets, you realize that there's a very huge potential for these folks to sort of earn returns. On the flip side of things, it's quite unfortunate that the cost per unit of items, if you think of real estate, for instance, now, cost of housing will likely go up, cost of new houses will likely go up by virtue of the impact of those interest rates, all right? So the investor in trying to gain his higher returns would sort of translate an increase per unit of those items to the different stakeholders who are using those items, those assets to start with. So, but to a large extent, it benefits the financial sector, although at the expense of the real sector. So those are top of mind things you must understand in terms of understanding how the interest rate works and how these things get to impact the local economy.
So, Damilola, I need you to react to that. Would you like to react to that? Hello, Damilola, are you there? Yeah, please go ahead.
Can you hear me?
Yes, I can hear you.
So
please
yes,
go
I
ahead.
completely agree with Vincent. And when he says, yes, when the interest rate it's most especially has more impact and significant positive impact on the financial sector, because it's also at the end of the day, it now brings about a what you call it, a lower propensity to consume. So because when he gave example of real estate, when interest rate goes up like that, in terms of real estate, people cannot consume as much as they would previously. But when it comes to investments, it simply means that as the interest rate goes higher, the investors who are potentially looking to invest are always interested in more interest rate because it is financially beneficial to them.
There's a need to enhance Nigeria's investment, climate and attract more diverse sectors for, foreign investment. This is critical, of course, to promote sustainable growth. How can Nigeria leverage the insight from the NBA's data? I mean, this is critical. We do know that, yes, the government is also working on their part to improve the investment climate in Nigeria. But how critical is this data? What can we do with this data? How do we improve on what you have done, going forward? Still on you, Damilola. Please speak on that.
Okay, so yes, in as much as we want to say the data shows an improvement, it also shows that there has been a decline. In 2022, total capital importation recorded was as at $5.3 billion, and the total recorded as at 2023 was a 3.8 billion, right? It simply shows that there has been a very great decline, almost 50% decline or 50.1% decline. And for us to improve on that climate of investment, there is a lot that needs to go into governance. And number one should be a bit of stability in the exchange rates. How am I sure that as an investor coming to invest and putting in my monies, bringing in my monies into the country, I'm not going to have a decrease, or I'm not going to have a loss at the end of the day. I'm buying a dollar for 1,600, and in the next couple of days, a dollar is 700 naira or 900 naira. There needs to be some form of stability in all of that. Also, yes, the government has done well by improving or increasing the interest rates. It also needs to maintain some level of stability, ensure that the ease of doing business, I keep going back to ease of doing business within the country, is fully established, especially at subnational level, not just at the federal level, especially at subnational level, because if it is improved at subnational level, it trickles up all the way and says, oh, I am investing more at the federal level.
Okay. I'm going to let both of you go in a moment, but let's speak to this. Obele, let me come to you. If you look at the PMI report released by the Stanbic IBTC Bank for February, we've seen that the PMI dropped from 54.5% in January to 51%, even though the outlook still looks very favorable. But speak to these. What does this mean for Nigeria in the coming days?
Well, the PMI is one of the PMI and inflation, to be honest with you, from an investor standpoint, are much more closely reliable data than GDP. And that's because the GDP is a bit reactive in its structure. It tells you what has happened in the last quarter, not what's happening in this quarter. But PMI and inflation are a bit more monthly and all that. However, it's important to note that the PMI is also a reflection of our past policy decisions or current policy decisions, especially when it comes to manufacturing and non-manufacturing sectors particularly. And I mentioned several times that the context of the Nigerian MPR journey has, not even just Nigerian, globally, interest rates have favored the financial markets over the real sector, and it's been a trade-off. And when you talk about the PMI captures what's going on in the real sector. So real sector-wise, the cost of borrowing has increased because interest rates have gone up. And once the cost of borrowing increases, businesses will slow down. So cost of manufacturing, cost of accessing raw materials and all of that. And take into consideration as well, the insecurity situation in Nigeria further worsens the supply side of the PMI. And if you also look at it in context of the fact that producers or businesses want to also be able to retain their profit margins, they will likely spread the cost to the per unit of an item, which means that consumers will get to pay more to use a particular item or enjoy a service. Now, safe to say as well, there are people within the Nigerian business landscape who generally the movement of the pricing and dollar and all of these narratives do not primarily affect them. But for fear of how it may impact them in the future, they get to also increase prices per unit of the items. So the overall perceived fear, and no, not really perceived fear, perceived state of things and actual state of things is worsening the general pricing dynamics in the Nigerian economy, both on the supply and demand side. And people are suffering for it. Businesses are suffering for it. These are the reasons why you see the PMI dropping, and it's not really favorable in the real sense. What's my outlook for the PMI? I think it may drop a bit further, or it may stay a bit on where it is right now, but it's likely going to drop a bit further because of the 400 basis hike in interest rate that we've seen recently. And that would significantly impact on cost of borrowing and cost of doing business, as well as consumer spend in the coming months. Indeed.
Let me get one more final reactions from you, Damilola, before I let you go. Yeah, we saw the GDP last quarter, GDP, increasing to about 3.46%. I mean, that's, of course, an improvement from what was recorded in the second quarter of 2023. Would you want to give us the outlook, how the economy, this is the last month in the first quarter of 2024. So what are you saying?
So yes, the GDP has risen, but we also need to take a close look at what are the contributors to this rise in the GDP. The financial sector most of the time contributes largely, but we also have to look at agricultural, manufacturing, which have also had lags behind because of the current state of things and the economic instability. So yes, going into the second quarter of 2024, first quarter is rounding up, as you have just said. Going into the second quarter, we need to also look inwards and say, how are we fostering more investments, or how are we fostering more productivity in these sectors to also bolster the increase in the GDP of the country? And at subnational level, what are they doing to ensure that they have they utilize all of their export potentials to also foster PPPs, that's the public-private partnerships, that will encourage not only investments and also job creations, which will in turn have effects on the GDP of the country.
I think a good place to leave it there. Thank you so much. From the United Kingdom, Mr. Gospel Vele, CEO, Streetnomics Limited, thank you for your time. And of course, Ms. Damilola Onemano, Gender and Research Analyst at Budget Foundation in Lagos. Thank you, both of you, for joining us on Business Nigeria.
Thank you for having me.